Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 stocks to consider buying before Q2 earnings season heats up next week. And all 3 of these companies that we're talking about today, which are Fastenal, which trades in the ticker FAST, so FAST, Taiwan Semiconductor, which trades in the ticker TSM, and Netflix, which trades in the ticker NFLX. I'll report their earnings next week. But before we get everything, remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into these 3 stocks to consider buying before Q2 earnings season heats up next week, let's just quickly go over where the market is at the moment and take a look at the broader earnings picture to give a sense of what's going on with these 3 particular companies. So Wall Street shook off the wave of trade war and tariff updates that plagued the beginning of the week and pushed the NASDAQ to new all-time highs on Wednesday. So I'm recording this Thursday afternoon, midday. The stock market's roughly flat as I record this. So the upbeat day in the middle of the week might signal that investors are learning lessons from the initial trade war fears and betting that Trump and his administration likely do not want to crush the U.S. economy or the stock market. So midweek, we saw NVIDIA hit all-time highs, briefly touching the $4 trillion market cap for the first time ever, as investors show that artificial intelligence trade continues to remain kind of the biggest bet on Wall Street. We also saw Bitcoin top new records in the middle of the week, briefly climbing above 1,200,000. It's unclear what's right around the corner on the trade war front, but it's worth remembering, as I said, that it's likely that Trump and his administration don't want to hurt the U.S. economy or the stock market too much. So kind of no matter what the social media posts or headlines are saying, investors are sort of remembering that they shook off that last tariff war, and it was much more shocking at the time. So Wall Street, though, still could use some of those renewed trade war headlines and unknowns as a catalyst to take profits heading into the unofficial start of Q2 earnings season, which is kind of JP Morgan and some of the big banks kicking things off next Tuesday, July 15th. And with that said, though, Delta shares were up huge on Thursday after they reported their Q2 earnings, and they reinstated their 2025 profit outlook as their CEO says bookings have stabilized. So that's a good start to the broader Q2 earnings season. With that in mind, let's take a look at what Zacks has for the overall S&P 500. We're calling for 4.7% earnings growth in Q2 on 4% higher sales. So this would come after 12% growth on the bottom line in the first quarter and 14% growth in the fourth quarter. And estimates have come down heading into the quarterly earnings season, which is often the case. So as long as guidance comes in pretty solid and companies beat expectation, which is often the case on a whole, that's kind of a good picture heading into this. And then if we look at an annual basis, we're calling for 7.1% earnings growth in 2025 after 10.6% growth last year. And then looking ahead to 2026 and 2027, we're calling for 13% growth next year and then 14% growth on the earnings front in 2027. So as long as earnings outlooks don't tank heading in or like throughout the Q2 earnings season, it seems like the bulls will remain in charge with the market at new all-time highs to kickstart July. So with that in mind, we're going to take a look at the first of these 3 stocks, which is Fastenal, which trades in the ticker FAST, and they actually report their Q2 earnings results on Monday, July 14th. So ahead of the kind of the first wave of companies reporting. As I said, JP Morgan is kind of the unofficial start of the busy portion of Q2 earnings season next Tuesday. So the company is a wholesale distributor of industrial construction, safety products, and beyond, ranging from fasteners and electric supplies to tools and hardware and building supplies and much more. It offers various distribution delivery methods, including industrial-style vending machines and other rather unique offerings. They operate out of 3,500 in-market locations. That includes local hubs, customer-specific online locations, and more. And they're operating across 25 countries. Fastenal is less vulnerable to the larger kind of boom and bust cycles of the broader industrial and construction sector because it doesn't sell those big ticket items. It benefits from kind of everyday economic growth in those various industries. It benefits from broader economic growth and obviously the wider infrastructure boom that's kind of just starting here in the US to support the AI expansion and long-term economic growth, which includes expanding the energy infrastructure in the United States. Its smaller components, as I said, are key cogs to kind of countless companies and industries functioning on a daily basis. So these aren't necessarily items that you need to for like a project that's going to take 5 years. You need this one thing to get it done. It's these things that you need all the time to operate your business. The company mainly serves customers in manufacturing and non-residential construction. Its manufacturing market customers include original equipment manufacturers and what they call maintenance and repair operations. Its non-residential construction market serves across general construction, electric, plumbing, sheet metal, road contractors, all that. So companies that are operating at all times kind of in the U.S. It's a pretty unique business. So as I said, they're selling anything you really need. So from electrical equipment to something as simple as tape or paint supplies or plumbing equipment to HVAC and refrigerators and various tools. And as I said, fasteners, that's kind of the name of the business. So overall, the company has grown its sales every year since the financial crisis, including 3% growth in 2024, 5% growth in 2023, and booming 16% growth in 2022. The company is coming up off a little bit of an earnings decline last year, 1% earnings decline in terms of GAAP earnings, and then its adjusted earnings were down about 0.5%. And this was after a big boom for it grew its sales or grew its earnings for a decade plus, including some big growth over the last several years. So looking ahead, we're calling for a return to strong top and bottom line growth. We're calling for 9% adjusted earnings growth in 2025, and then 10% adjusted earnings growth next year on the back of 8% higher sales in 2025 and then 8% higher sales in 2026. So a strong return to consistent growth for Fastenal is a good sign and shows that it's continuing to benefit from this broader economic expansion and construction expansion in the U.S. The earnings revisions had trended in the wrong direction for about the last year, but things are trending upwards recently, which is a good sign. That said, its overall earnings revision stagnation has it as Zacks ranked number 3 hold at the moment, but its industrial services industry is in the top 24 of 246 total Zacks industries. And it has a really strong balance sheet, and its dividends yielding 2% at the moment. And the company, its stock price has been really impressive. So the company is up roughly 2,200% over the last 25 years versus the industrial products sector, which is up about 450% during that stretch. So easily blowing that away. And then over the last 10 years, it's up 320%, which outpaces the S&P 500, which is up around 205%. So 320% run over the last decade for fast stock there. And then over the last 3 years, it is up 75%, which easily tops its industries or its sector's 50% run. So, and it just broke out to new all-time highs. So as I record this on Thursday, it's at new highs, and yet it's still trading around 5% under its average Zacks price target. It could face maybe some short-term selling. Obviously, if you're trying to buy for all 3 of these stocks we're talking about today, it's always worth qualifying. If you're trying to buy it just for the post-earnings pop, that's always a risky proposition, especially considering the rally the market's had. But if you're a longer-term investor, certainly worth considering buying these ahead of earnings, as the long-term upside is there for all these. It's trading solidly above its 21-day moving average. As I said, it just ripped a new all-time high. So it could see a little bit of a pullback, especially if it slightly underwhelms on the top or bottom line, or its guidance comes in a little bit below. And then in terms of its valuation, it's trading as the stock's now at all-time highs. Its valuation's edging right back near all-time highs. So it's possible that it might need a little bit of a recalibration, but overall, Fastenal stock seems like a long-term winner as part of a diversified portfolio, and it gives you exposure to broader construction and industrial spending and the energy boom that's going to happen in the United States. without having to kind of pick like a bigger winner. So since it serves a lot of different businesses in that broader area. So now we're going to move on to a totally different company that's not in that business at all, that reports its earnings on Thursday, July 17th, and that is Taiwan Semiconductor Manufacturing Company, which trades in the ticker TSM. So physically building the most complex and cutting edge semiconductors makes Taiwan Semiconductor Manufacturing Company. So TSM is the ticker, TSMC, Taiwan Semi. Those are all the names that it goes by. One of the most straightforward, all-encompassing tech investments across AI, electronics, and future tech innovations that we don't even know at the moment, aren't even around yet. So Taiwan Semi's foundry-only model slowly transformed into one of the only games in town for semiconductor manufacturing, especially at the bleeding edge. This backdrop is why TSM stock has skyrocketed 2,600% over the past 20 years, more than tripling the tech sector. Taiwan Semi reportedly holds roughly 60% market share of the entire foundry business and 90% of the advanced chip manufacturing, boasting clients such as Apple and other tech titans. NVIDIA's massive AI expansion likely wouldn't even be possible without TSMC. It's also critically expanding outside of Taiwan to address geopolitical fears. It's now has operations in Japan, and it's spending a bunch of money to open up foundries here in the United States. It also pays a dividend and has a really solid balance sheet. It's boosting its industry-leading 3-nanometer production, fueled by AI chip companies such as NVIDIA and AMD. The pure play foundry company said that its 3-nanometer chips accounted for 22% of total wafer revenue in the first quarter of 2025, up from just 9% in the year-ago period, with advanced technologies accounting for what it calls advanced technologies, accounting for 73% of its total Wayfair revenue. And on July 10th, it reported its June sales. So it reports its monthly sales. Its monthly sales were up 40% year over year. So it's another really solid sign. Wall Street might have been a little disappointed that they were down compared to May, but year over year, they were up 40%, which is a great sign. So looking ahead, we're calling for its revenue to climb roughly 29% in 2025 and then 17% in 2026. This would follow 25% growth last year. This would see it go from $90 billion in total sales in 2024 to roughly $137 billion in 2026. And then on the adjusted earnings front, we're calling for 32% growth this year and then 16% growth next year. And its positive earnings revisions help it land a Zacks ranked number 2 buy at the moment and extend its stretch of improving AI boost earnings growth. It's also topped our estimates for 5 years running. The stock might be a little overheated, kind of like the entire market at this moment, but no one can say exactly how long this rally will last. So don't try to time things too closely if you're a longer term investor. And it's also still trading at a 33% discount to its highs and 18% below tech at just 22.6 times forward 12-month earnings. And it's also trading 35% below tech and 75% below its highs when we look at its PEG ratio. So that's sitting at 1.1, which is really impressive when you consider the tech's at 1.7 and it's crushed the broader tech sector over the last 20 years. And it's a really all-encompassing kind of AI and tech bet for the long haul. So any pullback to maybe its 21-day or 50-day could represent maybe more enticing buying opportunities for traders or investors who kind of want to get in at these like great exact moments that they're looking for. Others might want to wait for their Q2 earnings results to actually come out, and maybe there's a larger pullback if they report some underwhelming guidance. But long-term investors might want to avoid that market timing game and buy Taiwan Semiconductor for the long haul. And now we're going to take a look at Netflix, which trades the ticker NFLX. And they also report their Q2 earnings on Thursday, July 17th. So the company's shares have jumped roughly 40% year to date, crushing the S&P 500, which is up just 6%. The stock is now up roughly 90% over the past year, which is even more impressive because it's not fueled by any kind of artificial intelligence hype or this future expected growth that hasn't really come to fruition yet. Wall Street's jumped back into the streaming company due to its ability to raise prices, streamline operations, and grow its user base, roll out more content, and most importantly, expand the bottom line. So the streaming TV technology giant is less exposed to tariffs and any kind of broader economic shakeups than some of its big tech peers. It's also, as I said, at home entertainment is something that most people are going to continue to spend on during both good and bad economic times. Netflix has also improved its balance sheet, and its board authorized a $15 billion stock buyback program. On top of that, the company doesn't need to spend billions on data centers and other AI-focused growth efforts to succeed. And on the speculative note, and as I said, this is totally speculative, it could be due for a stock split since it's currently trading for over $1,200 per share. Netflix has outperformed most of the largest tech companies over the past 20 years. It's been one of the best stocks over the last 20 plus years and remaining nearly neck and neck with NVIDIA. Its transition to profitable growth helped the stock skyrocket from its 2022 lows. So it's outpaced every Mag 7 stock over the past 3 years, except for NVIDIA, with the stock up 615% over the last 3 years. So if we look kind of on the broader business side of what's attracting Wall Street and users, it's expansion into live sports. So it deals with the NFL, WWE, boxing, reality TV, blockbuster movies, has helped it retain and attract subscribers. The company's also been highly successful in launching, as I said, lower cost products like reality TV. Those blockbuster movies can cost a lot of money. So getting these lower end shows that draw in users is a good sign. They're also in the early stages of rolling out their video game content. I don't know if you're a Netflix user, but you definitely have seen ads for video games on Netflix now where you can play video games right on Netflix. Netflix has also rolled out lower cost ad supported subscription plans. It did that first in the fall of 2022. Its ad-supported tier accounted for more than 55% of its Q4 signups in countries where it was available. And this company said it added roughly 19 million paid subscriptions in Q4, marking its largest quarter of net ads on record, closing 2024 with 301.6 million. So roughly 302 million global paid memberships, up 16% year over year. It's also successfully differentiated itself from a pricing standpoint with its $7.99 per month ad-supported tier coming in much lower than Disney's $9.99 ad-supported tier and well below its various bundling options with Hulu and HBO Max. The streaming powerhouse grew its revenue by 16% in 2024 to roughly $39 billion. And while its top-line growth may never return to those pre-COVID levels, its recent growth marks a return to that strong double-digit expansion following back-to-back years of 7% sales growth in 2022 and 2023. So looking ahead, we're calling for a roughly 13% revenue growth in 2025 and 2026 to get up to roughly $50 billion next year. So 2026 doubling its 2020 total, which is really impressive. Netflix is projected to grow its adjusted earnings by 28% this year and then 22% next year, following a whopping 65% expansion last year. It's also set to grow its GAAP earnings nearly fivefold between 2020 and 2026. Valuation-wise, this is the really impressive part and why Wall Street's dove headfirst back into the stock, is it's now trading at a 90% discount to its 10-year highs and 50% below its 5-year highs and a 35% discount to its 10-year median, even though it's trading right near its all-time highs in terms of price. It's still maybe a little pricey overall compared to the broader tech space. And it's trading at 46.8 times, so roughly 47 times forward 12-month earnings. And it's trading at a bit of a premium to tech in terms of its price to earnings growth ratio. Its PEG ratio at 2.1 versus tech's at 1.7, but still way below its highs over the last 5 years. It traded as high as 4, a PEG ratio of 4. So its valuation is impressive. It hit all-time highs right at the beginning of July. It is, as I record this, it's down Thursday afternoon. It's trying to hold the line. It's 21-day moving average. If it falls to that 50-day, that could be kind of a larger buying opportunity heading into that earnings release. But as I said, if you're a longer-term investor, Netflix has proven that it could be a great tech and entertainment stock to own that's not all based on AI. So kind of as every tech company goes all in on an AI future, Netflix could be a name to kind of have it in your portfolio that's not betting on any AI company to kind of shine in an AI world. We're not really sure exactly what it's going to look like. So Netflix is certainly one to put on your radar, along with Taiwan Semiconductor and Fastenal. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.